Major UK tax changes coming into effect from 6 April 2025 that could seriously affect your wallet. Whether you are an employer, homeowner, or landlord, these upcoming rules may mean bigger tax bills. Stick around because I will show you how these changes work and what you need to do to stay ahead of the game. If you're new here, my name is Rubina. I'm a qualified accountant and experienced tax advisor. This video is for general guidance only, not a personalized advice. If you find this video helpful, please hit that like button, subscribe, and share with anyone who need to hear about these big changes. Number 1. Employer National Insurance Contribution Changes. From April 6, 2025, the employer's secondary class 1 national insurance rate is increasing from 13.8% to 15%. This also applies to Class 1A and 1B national insurance contributions, which means expenses and benefits you provide to employees will cost more in NICs. Another big change is the secondary threshold, which is dropping from £9,100 to £5,000 per year. So, if you employ staff earning £5,000 or more, you must start paying employer NICs and reporting to HMRC. For businesses already using payroll software, this will be automatically updated. But if you are new to paying employer NICs, you need to register for PAYE with HMRC and set up payroll software. Action items. If you are hiring, make sure your payroll system is ready before April 6. There is some good news. From April 2025, the £100,000 NIC bill threshold is being abolished, so more businesses can apply. The maximum employment allowance amount is increasing from £5,000 to £10,500, meaning eligible employers can save more on their NIC bills. However, not all businesses can claim employment allowance. Public sector employers and single director companies with no employees are not entitled. So, how can you prepare before April 2025? Quick checklist. Review your payroll cost. Factor in the 15% NIC rate increase. Check if your employees earn over £5,000. You may need to start paying NICs. Check your employment allowance eligibility. You might save up to £10,500. Number 2. Vehicle excise duty changes. Currently, fully electric cars have been exempt, but from April 2025, that is changing. Here is what you need to know. Electric vehicles pay vehicle excise duty starting April 2025. Electric vehicle owners will no longer enjoy a zero VED privilege. For vehicles registered after April 2017, including electric vehicles, there will be an annual standard rate around £90 once the first year rate has passed. Higher first year rates for high emission vehicles, big engine petrol and diesel cars like large SUVs or performance vehicles will be hit hardest. For instance, if you're buying a brand new high-CO₂ car, your first year VET could double, potentially jumping from around 1,650 to over £3,000. The government expects to raise around 2 billion more by 2027-28 from these changes alone. So, if you're eyeing a new or used car, especially a higher emission model, budget for steeper road tax. Number 3, capital gains tax. Now, let's talk about capital gains tax. This applies when you sell a chargeable asset worth over £6,000, which can be anything from crypto assets to second properties to valuable personal items. Several big changes are lined up. Number 1, increased capital gain tax rates from 2025. For basic rate taxpayers, the capital gain tax rate jumps from 10% to 18%. For higher or additional rate taxpayers, it increases from 20% to 24%. So, if you sell cryptocurrency, shares, or a second home, After 6 April 2025, your capital gain tax bill will be higher than if you sold in 2024. Number two, business asset disposal relief adjustments, formerly known as entrepreneurs relief. Business asset disposal relief lets qualifying business owners sell their companies at a reduced capital gains tax rate. Right now, if you sell your business and qualify, you pay just 10% on the gains. From April 2025, that preferential rate rises to 14%. By 2026, it is climbing again to 18%. Why that increase? This relief costs the government over 1.5 billion each year, so they are tightening up the rules. If you are considering selling your business, think about the timing. A sale before these rate hikes might save you thousands or even tens of thousands in tax. Number four, furnished holiday lettings. If you own a short term rental or Airbnb, from April 2025, the government is scaling back many of the tax advantages of running these furnished holiday lettings. Number one is the mortgage interest relief capped at 20%, like standard buy to let landlords. You will no longer be able to deduct all of your mortgage interest from rental income if you are a higher or additional rate taxpayer. Instead, you will receive a 20% tax credit. For example, if you earn £30,000 from an Airbnb with £6,000 mortgage interest, before you could deduct the £6,000 in full if you met furnished holiday letting conditions. So you would be taxed on 24,000 at 40%. That's equal to £9,600 tax. After the change, you are taxed on the full £30,000 at 40%, that is £12,000. Then get a 20% credit on the £6,000 interest, that is £1,200. Your final bill would be 10,800, that is an extra 1,200 in tax. Capital gains tax on furnished holiday sales. Currently, if you sell a qualifying furnished holiday lettings business, you may get business asset disposal relief at 10%. From April 2025, furnished holiday letting properties no longer qualify for the reduced rate. That means you will likely pay 24% if you are a higher or additional rate taxpayers on any gain from selling your furnished holiday letting. So, for £100,000 gain, instead of paying £10,000, you might pay £24,000, a huge jump. Number five, stamp duty land tax thresholds. But if you are buying a property in 2025, be prepared for higher stamp duty. First time buyers. The nil rate band, the amount on which you pay no SDLT, drops from £425,000 to £300,000. The property's total value must not exceed £500,000, down from £625,000 to claim the relief. More first time buyers could end up paying stamp duty they would not have paid before. Other buyers, for existing homeowners, selling one main home and buying another, the nil rate band falls from £250,000 to £125,000. That means if you're purchasing a home above £125,000, you will start paying stamp duty earlier and on a larger proportion of the purchase price. For a property worth £750,000, the difference could be a significant extra 25,000 in stamp duty land tax. So if you're planning to move or invest in 2025, factor in these higher stamp duty land tax costs. You may need a bigger deposit or to negotiate more aggressively on price. Number six, end of non-dom tax benefits. Finally, the government is overhauling the non-dom status rules from April 2025. Up until now, UK residents claiming non-dom status could avoid UK tax on worldwide income and gains, provided they did not bring it into the UK by paying a remittance basis charge. What is changing? Domicile concept disregarded for tax if you are UK resident. you will automatically be taxed on your worldwide income and gains. This closes the loophole where someone could say their domicile is in Dubai or somewhere else to shelter foreign income. 4-year foreign income exemption. The government will introduce a 4-year grace period for those who have lived abroad for at least 10 years before coming to the UK. During these 4 years, they won't pay UK tax on their foreign income and gains, even if they remit them to the UK. After 4 years, they will be fully taxed in the UK like everyone else. If you have been relying on non-domicile status for large foreign dividends, interest, or capital gains, you need a new strategy. These changes bring much more of your global income into HMRC's scope. And that is it. The major tax changes heading our way that could affect anyone from employer NI, electric car owners, and property investors, or individuals relying on non-dom status. Vehicle excise duty is no longer friendly to electric cars. Capital gains tax is going up, especially for business sales. Furnished holiday lettings lose key tax advantages. Stamp duty thresholds are lowering, which could cost buyers more. Employers' NI may affect employees' increment or new hiring. Non-domicile status is being heavily restricted. What should you do now if you are planning major transactions like selling a business, a second property, or even holiday let? Timing could save you thousands in tax. Review your mortgage position if you have Airbnb or short-term lets. Start budgeting if you rely on private education of your children. If you have historically used non-domicile status, get professional advice as soon as possible. If you found this video helpful, please hit that subscribe button.